All right, today we are jumping into one of the biggest debates for any investor, VOO or VTI. Now, this is a classic showdown for sure, but we're adding a really specific twist. We're looking at the unique economic battlefield of 2026 to figure out which of these titans is really set up to win. Let's get right into it. And make no mistake, this is a high-stakes decision. The forces that are shaping 2026, I'm talking everything from the AI boom to some huge policy shifts, mean that last year's winning strategy, well, it just might not cut it this year. Picking the right one of these for the core of your portfolio could make all the difference. Okay, so before we dive into the nitty-gritty of 2026, we've got to do a quick tale of the tape. Let's meet our two contenders and really get what makes them tick. This is the core DNA of each fund, and it is absolutely crucial for everything that's about to follow. So the difference here is actually pretty straightforward when you boil it down. Think of VOO as the blue chip champion. It's focused laser sharp on the S&P 500. You know, the 500 biggest, baddest US companies. VTI, on the other hand, is kind of like the people's champion. It holds the entire US market. We're talking large caps, mid caps, small caps. If it's a publicly traded US stock, chances are it's in VTI. And you can really see that difference pop out in the numbers. I mean, look at this. VTI holds over 3,400 stocks, while VOO is sitting there with just over 500. And that directly impacts your risk. With VOO, almost half of your money is concentrated in just 15 companies. VTI spreads that risk out way more. It's that classic trade-off, right? A concentrated bet versus wide diversification. Now, this fight isn't happening in a vacuum. The specific economic arena of 2026, well, it has its own rules, its own challenges, and its own opportunities. Understanding this backdrop is absolutely key to picking our winner. Analysis from all the big firms, JP Morgan, Citi, they're all pointing to three defining forces for the year. First up, the AI supercycle isn't slowing down. If anything, it feels like it's just getting warmed up. Second, there's this growing feeling that market leadership is finally broadening out beyond just a handful of tech giants. And third, there's a massive new fiscal policy on the horizon that's set to really shake things up, especially for domestic companies. So here's what the consensus is looking like. We're expecting pretty solid GDP growth, somewhere between 2.2 and 2.8%, with inflation continuing to cool off. But here's the thing. Even these small differences in forecasts have huge implications. A higher growth world, like the one Goldman Sachs is predicting, often gives a boost to the more cyclical, smaller companies you find more of in VTI. A slower environment, though, that can send investors running for the perceived safety of VOO's giants. So with the stage set, let's head over to the reigning champions corner. The case for VOO in 2026 is a really powerful one, and it's built on a simple idea. The biggest and the best are just going to keep getting bigger and better. It is a full-throated bet on AI exceptionalism. The core argument here is that the AI revolution requires an absolutely insane amount of capital, and really only the S&P 500 titans have the kind of cash needed to truly compete at that level. This could create a winner-takes-all or winner-takes-most dynamic where the hyperscalers, the very companies that dominate VOO's top holdings, capture the lion's share of all the profits. And the numbers really back this up. JP Morgan is projecting that this AI supercycle is going to drive incredible earnings growth of 13 to 15% for the S&P 500. Now, this isn't just wishful thinking. This is a forecast for some serious above-average profit momentum for the exact companies that live inside VOO. And it's not just the analysts who are bullish. You know what they say, follow the money. And wow, look where the money is going. Over $16 billion have already poured into VOO just this year. That is immense institutional momentum. The big money is still betting heavily on the large cap leaders, and that creates a really powerful tailwind for the fund. And finally, there's the whole safety argument. In a world that's, well, let's just say it's facing some geopolitical uncertainty, investors crave stability. The massive cash-rich companies inside VOO have what people call fortress balance sheets. They're seen as a safe haven, a port in the storm, and that's a very, very attractive quality in the 2026 environment. But hey, what about the challenger? The case for VTI is a true comeback story. It's the argument that after years and years of large cap dominance, 2026 is the year that the rest of the market finally gets its time in the sun. It's a bet on market breadth. So the bull case for VTI is really built on three solid pillars. First, valuations. The big guys are expensive, and a correction just feels kind of overdue. Second, earnings. Believe it or not, the smaller companies inside VTI are actually projected to grow their earnings faster. And third, policy. There's a major new law that could provide a direct tailwind. So let's start with those earnings. While the S&P 500 is expected to grow earnings by a very respectable 14.8%, the small cap companies, the ones that VTI holds but VO doesn't, are projected to grow by a staggering 19%. This means VTI has a ticket to a much faster growing part of the market. Next up, there's that policy catalyst. A new round of fiscal stimulus, specifically designed to incentivize domestic production, could be a major game changer. And since VTI has much higher exposure to these domestic-focused industrial companies than VOO's global giants do, this policy could directly and disproportionately benefit its holdings. And finally, maybe the biggest argument of all, the price tag. After years of underperformance, small and mid-cap stocks are trading at a historic 25 to 40% discount compared to large caps. They are, for all intents and purposes, on sale. And that creates a super compelling case for a rebound as investors start hunting for value again. Okay, so we've heard the arguments from both corners. We have the AI exceptionalism of VOO versus the broad market comeback story of VTI. It is time to weigh the evidence, look at the 2026 landscape, and deliver a final verdict. So here it is, the final showdown, laid out side by side. On one side, VOO has that powerful AI supercycle narrative, massive investor momentum, and its reputation as a safe harbor. On the other side, VTI has a historic valuation opportunity, superior projected earnings growth, and a brand new fiscal policy that seems perfectly aligned with its holding. And the winner for 2026, based on our analysis, is VTI. So why? What gives it the edge? It's this powerful convergence of factors that you just don't see every year. The combination of that fiscal stimulus, that massive valuation gap, and an AI cycle that's finally broadening beyond just the mega caps, it all creates a unique strategic advantage for this specific year. This quote I saw from a retail investor really just nails the whole long-term argument. It says, VOO will get you the Amazons and the Netflixes after they're already giants. But VTI gets you exposure to them while they're still on the way up, while they're still growing through their small and mid-cap phases. It's a bet on tomorrow's winners, not just a bet on today's. So why does this matter for your portfolio? Look, the whole story of 2026 seems to be about this predicted broadening of market leadership. By owning VTI, you aren't artificially cutting yourself off from the thousands of small and mid-sized companies that are perfectly poised to lead that charge. You're simply betting on the entire U.S. economy, not just the top slice of it. And I want to end on this really powerful thought from BlackRock. They say 2026 looks like an investor's market, not a gambler's. In a complex year where surprises are not just possible, but likely, what's the more prudent choice? Is it a concentrated gamble on the top 500 companies, or is it a diversified investment across the entire field? For 2026, the evidence seems to suggest the broader bet is the smarter one.